Hi everyone, today we will be overviewing gym or fitness center financial model. So if you find these overviews valuable, please like, share and subscribe to our channel. We also do some Power BI stuff here, so if you have an existing business, we can also create some powerful dashboards, insightful dashboards for your currently operating business. So first of all, we need to create the rule that will be saying that we need to distinct the inputs from other formulas. So you or any third parties that will be using this model, all of them should be able to find the inputs easily. That's why we need to create some unique color for all the inputs, so you, your business partners, bankers or any third parties would be able to find the inputs easily. So in this case we are saying that all inputs will be colored with this blue color. So in future, many steps ahead, when you will be making scenarios and stress tests, or your business partners will be making stress tests with your financial model, so this will be very convenient for all these people to find the inputs through the whole financial model. So this is the rule number one and the most important rule. So now let's start with the inputs. I will be covering all types of inputs here that affect financial efficiency of this model or of this type of business. So first of all, we need to set up the first year when we start our financial projections. Basically, it's the year when we start the investment stage. Then we need to specify when we start the revenue, when the first when the first cash flow is being generated by the project. So here we can specify the month and year when we get the first revenues. Then we are moving to the first and I think most important block of inputs. We start talking about the revenue generating algorithm. So it doesn't matter what type of business you are looking at, you need to create a credible revenue generating algorithm for you, for the third parties, because you need to be able to trust all the outputs that you will see. So once you create the cash flow statement, you will be able to see the cash flow statement. Once you see the simple and discounted payback period, you need to understand that these numbers are realistic, and that's why you need to create the revenue generating algorithm as much detailed as possible. So then once you see the simple discounted payback period chart, the cash flow statement, you will know that you are very close to the real numbers. Try to avoid average values, so try to be as detailed as possible. That's the main rule that you have to apply when you are trying to start any business idea, no matter what it is: gym, fitness center, bakery, chain of restaurants, no matters. Try to be as detailed as possible, describing revenues or expenses. So first of all, we have, in this particular case, we are looking at different types of members, people who are attending our gym or our fitness center. So these are different types of people. So these are we will be describing the portraits of visitors, of members that attend your gym. You can name them one by one, and then the next column illustrates us the ability to switch on and off each type of member. So for example, if you are too optimistic with the with different parameters that apply to this type of member, you will be able to quickly switch it off and see quickly the cash flow statement, pin simple and discounted payback period with or without this type of member. And this will give you a lot. So for example, if you are too optimistic, you will see that simple and discounted payback period are going down. Cash flow statement is looking bad. So this means that you need to rethink your business concept. So these switch on and off buttons are giving you the chance to do very important stress testing environment once your financial model is ready, your business idea, so your business concept is ready. And what you can do, you can switch on and off different types of members and see how your cash flow will be looking if you, for example, switch off the most valuable types of customers from your calculations. And very often when financial model is ready, so future business owners start to experiment with these scenarios, and they see that they are too optimistic and they need to rethink their business concept while they are playing with these on-off toggles. So this is very important. So once your model is ready, you will be playing with this block of input a lot. Then we are moving to the next column. So this is the membership fee for different types of customers. So this is how many dollars we are paying per period, and the period may be, so some of them will be paying per 3 months, per 6 months, let's say per quarter, per half a year, per 9 months, or they will be paying us $450 once in a year annually. Some of them will be paying us every month. So here we are specifying the payment, membership payment. Here we are specifying how often this payment is made, and then we are describing a very important parameter. We are describing the customer's life cycle in months. So many business owners, when they start some new business projects, they think that the customers that are joining their business idea, they will stay with their business forever. But basically it's not true. This means that one day every type of customer that, for example, joins the gym today, they will disappear in year or 2 years or 6 months or 3 years and so on. And this means that the revenues will decrease somewhere in the future. And we need to create some algorithm that will be taking into consideration this factor. So in here we're saying that this type of customer will basically stay with us for 1 year. This one will be staying us for 2 years, for 3 years, for 4 years, 5, 6, and so on. And for example, some types of customers may stay with us just for 1 month and then quit. So this creates the credibility for the revenues, because somewhere in the future this customer will disappear. It will decrease the revenues, and the revenues will be looking more realistically. This will bring you the realistic loan coverage ratio numbers. This will give you more realistic simple and discounted payback period values, and so on. So this is very important block that gives you the realistic revenue numbers and direct cost numbers inside your financial model. Then we are adding a coefficient to the amount of customers. So again, we are talking about stress testing and scenario building environments. So once your model is ready and you would like to see, so for example, if we decrease the amount of customers, let's say type number 30 by 50%, you can just type it 50% here, and you will be going to the cash flow statement, and you will see how the cash flow performs if we have just 50% of member type number 30, and see how this will affect the simple, discounted payback period, net present value, profitability index, and so on, without touching a huge amount of input. So this coefficient significantly simplifies the stress testing procedures that you will be doing once your financial model will be ready. Going forward, now we are looking at the trainers in detail. So for example, we're starting with bonus for the trainer. So let's say we have the revenues. So we have two types of revenues. The first type of revenue is membership revenue, and the second type of revenue is the revenue from personal training. And here we're specifying the bonus that goes to the trainer, and we're specifying it in percentage from the revenues from training. And again, we have here different types of customers. We have one customer, so we're describing just one customer, one member, and we are looking at typical year, and we are setting up the revenue with its seasonality inside the typical year for each type of member. So for example, in summer months the revenue from training may decrease, in winter months it can increase, and so on. So every gym has its own specific seasonality algorithms. So here from top to the bottom we have membership types, and here we have the revenues from the training for each member, for each membership type. Here it is. So once we describe one member and and his revenues from the training, we can proceed to the amount of new customers. So now we're moving to the new customers, new members of our gym that are becoming our customers. So here we have the timeline, the first 24 months of operating activity. Then these numbers will be extrapolated of new customers, new members that will be joining our gym. So this why these numbers will be extrapolated, and these numbers we can specify one by one, or month by month. So we are starting with so what this table of inputs tells us. So this means that on May 2020 we have 30 new customers of membership type number 1, and these 30 guys will stay with us for 12 months, and each of them will be paying $300 every 3 months. And of course we can switch them on and off. So this means that here we have new 30 customers, and they will somewhere in the future will disappear. So this means that we are building a credible revenue generating algorithm. So here we're describing only new customers, new members that are joining our gym. Now we're moving to investment plan. So as you can see here on the right, this is the month and year when we start the operating activity, when we get the first revenues. And if we look backwards, we will be able to set up the investment plan. So from top to the bottom we are specifying what we are investing in during the investment stage, and here we are specifying how much we are investing in during the investment stage. If we change the month and year in this block of inputs, these values will automatically change, and of course this will affect the cash flow statement. So here is the May, and this is the investment stage going to the left, to the past from the May 2020. So this is very important. When you are done with your financial model, you will be playing with these inputs a lot, and you won't have to retype the huge amount of new customers, investment plan expenses, payroll, fixed costs. So all these revenues and expenses are automatically linked to this block of inputs. So this saves you a lot of time, plus you are avoiding making huge amount of mistakes that entrepreneurs usually make when they build the models themselves. So they forget to, when they display the revenues, they forgot to display the revenues or expenses or investment plan or anything else, or they are forgetting to display all these parameters. So that's why we don't have the ability of making this mistake. We just specify when we get the first revenues, all the revenue starts counting as of this date, month and year, and all the investment stage expenses are also linked to this moment inside the timeline. So this is very important. This will avoid huge amount of mistakes. Your cash flow will be looking so this block of inputs will save you a lot of time. You will avoid mistakes. So if you just have to specify the starting point of your revenues, and all the investment plan stage will be linked to this moment, and all the revenues, direct cost expenses, fixed cost expenses will also be linked to this very moment. So this is very convenient for those who are building scenarios, stress testing, and so on. For all the third parties, you don't have to retype all the inputs, because sometimes you are building very huge projects and it takes time to retype the inputs. So believe me, that will save you a lot of time while stress testing actions and scenario building. Moving forward, now we are describing the payroll. So we have the list of positions, then we specify the payroll for one person on each position, we specify how many people we have on each position, then we have this payroll, and this payroll automatically will also start with the moment when we get the first revenue. So you don't have to displace these numbers, so they are also automized. Then we are moving to the fixed costs. So despite of them being so called, here we have the list of fixed costs. They may also have some seasonality. So in summer month we can have increase or decrease in this or that type of cost. Some of these costs may be paid once a year, or once a month, or once in a quarter, or they may have some specific algorithm then of payments. That's why we have a typical year, and inside the typical year we are placing the numbers of expenses for each fixed cost item. This will also add some realism to your financial model. You will be able to see some potential surges in, let's say, fixed costs. Maybe these surges may produce some operating losses inside your cash flow. So it's also very important to look at the fixed costs in details, because, well, sometimes people just take one value, extrapolate it from left to right, from January till December, but in reality, so this payment may have some specific algorithm inside the typical year. This may produce, for example, some expenses surges, and this means that inside the cash flow statement you will be able to see you won't be able to see the operating losses, and without seeing the operating losses you will not be able to see the real amount of financing that you will need to start the business. So this is very important. So that's why you need to specify all the fixed costs inside the typical year to calculate the right amount of financing that you will need. Now we're going to the depreciation. So we are specifying what we are whether we are applying depreciation or not, and if yes, we are specifying the depreciation in months for each investment plan item. Now we're moving to the taxes. So we have different types of taxes here. So we have value added tax, asset tax, salary tax, net profit tax, means revenue minus costs, revenues tax, revenues minus cost tax, and so on. So we have the different rates here, and here we can see the tax base for each tax. So for value added tax, it is added value. For asset tax, it is the current amount, current value of the assets at every given moment inside the timeline. Here is the salary, P&L profit, revenues, and revenues minus all costs. So here we can specify different tax systems, and that will affect the taxes line inside the cash flow statement. Now we are proceeding to the cash flow. So now we're moving to the cash flow statement. Here it is. So first of all, we need to, so cash flow statement is divided into three parts. This is the operating activity, investment plan activity, and financing activity. So the first part, here it is. It's revenues minus payroll, minus fixed costs, minus direct costs, minus taxes, is showing us how our business operates itself without external investment plan expenses and without loan payments, interest and principal payments. So what is variable here? So inside the result from operating activity, we may have some operating losses. Here they are. This means that according to the inputs that we made earlier, the project, our financial model is showing us that we need some additional financing added to the investment plan expenses. So here are the investment plan expenses. Here they are. So we can press plus and see all the details for the revenues, payroll, fixed costs, direct costs, and so on. So here we can see the investment plan expenses, plus if we want to calculate the right amount of financing that you will need to start this business, we will need to add these operating losses to these investment plan expenses, and as a result you will be able to see how much financing you will need in totals. And these operating losses will be shown you only if you do a detailed work with your revenues generating algorithm, if you do detailed homework with your revenues from training, if you do detailed homework with the new amount of customers that will be joining your gym, then you will be able to see the potential operating losses. So when your financial will be ready, many steps ahead, you will be playing with all these inputs and you will be looking at this amount of operating losses. For example, in this case you have only 3 months of operating losses, but in some scenarios you may have 6 months of operating losses, 12 months of operating losses. The amount of losses will be different, and playing with different scenarios, you will be able to see the gap between optimistic scenario, pessimistic scenario, how you're gonna start your business in this or in that scenario. So you will be playing a lot with the inputs, looking at the total financing. So here we have total financing needed, that consists of equity, your own money, a loan that you will be gaining, for example, and you will be playing with the inputs, and you will see how many dollars in the pocket you need in this or that scenario. So the result from operating activity is showing us the let's say roughly the profit that we have after revenues minus payroll minus fixed costs minus direct costs minus taxes. So now we're moving to the investment stage. So the result from investment stage is showing us how much financing we need to cover all the investment stage expenses. Here they are. Then we're moving to financing activity, and financing activity is showing us in this particular case how much of equity we need, how much of loan we need to start this particular scenario. It's showing us the inflow of our money, inflow of the loan, and it's showing us the payments that we're making for the loan, interest and principal payments. And then if we look at the cash balance at the end of the period, we will be able to see that the period when we are eating the cash, here it is. So here we have the decrease in cash. This is mathematical zero. And then as of September 2020, the cash starts growing. So this means after this point we don't need extra financing to start to finance our business idea. Then we are moving to the discount rate, and here we have the basic financial efficiency numbers for this specific scenario. Simple discounted payback period, profitability index, net value, net present value, total financing needed, internal rate of return value. If we have any loans, we can specify them here. So we can specify the amount of loan, when we get this loan, year and month, term of loan in months, interest rate. If we have any grace period for the interest payments or principal payments, we can specify it here. So we have a couple of block of inputs for the loans. All these loans are running here, so they're hiding behind these plus buttons. Then we have some charts: simple and discounted payback period chart, loan coverage ratio, revenues and total costs, then profitability numbers, cash balance at the end of the period, operating profit and debt payment monthly. Then we have the same numbers represented by year. Here they are. Then we have cash flow statement and P&L statement produced yearly. We also have very simple table with revenues, total cost, profit, profitability, cash balance at the end of the period, operating profit, discounted cash flow, and so on. It's here. And then for the stress testing purposes, we have a couple of yellow tabs. Each tab represents its own parameter that affects the sensitivity analysis. So one sensitivity analysis will be done for the revenues, for the payroll, for the cost, fixed cost, direct costs, investment plan expenses, interest rate value, loan amount value. So once we are done with scenarios, so we have the pace of changing the parameter. So for example, if revenues will be increasing by 15% higher or lower, so we will be able to see what will happen with the financial efficiency in this particular scenario. So we can press the button, sense button, and see what will happen. We can also increase this parameter. So this parameter affects this line. So for example, we would like to increase the pace. We can delete this data and press sense button again. So the same story goes with all types of parameters that we're using for sensitivity analysis: payroll, fixed cost, direct cost. So I will be going tab by tab and pressing this button. So usually when financial model is ready, entrepreneurs are playing with sensitivity analysis a lot, so they are building different scenarios using the coefficients. They are switching on and off different types of customers. They are playing with when they are going to start the revenues. They are playing with different types of revenues, the percentages of new customers, new members. They are playing with the investment plan expenses. Then they are looking at the cash flow statement. They are start looking at stress testing blocks for the revenues, payroll, other parameters that affect the cash flow statement. So usually it takes entrepreneurs a time to build a realistic scenario that will be brought to the life, that finally will be applied as a business idea. So I hope you enjoyed this financial model overview. We have, let's say, several hundreds of different models. We will be overviewing them on this channel. Also, we are doing some Power BI stuff. If you find these overviews valuable, please like, share and subscribe to our YouTube channel. Thanks for watching. See you next videos and bye.